Bob, when did you start investing with JWB?
Well, I've been investing for, unfortunately about 40 years, a long time. I started right out of college and invested in stocks, bonds, options. Over the years, I've done those plus, MLPs, REITs, ETFs, warrants. More recently, cryptocurrencies. I've done precious metals. So I've invested a lot of different asset classes over the years. But I have a particular interest in real estate. And actually, I've increased my real estate holdings over the last couple of years, especially in various areas. And that's what brought me to JWB. I made my investments with JWB in the middle of 2021. A number of things. One is, the stock market has gone up a lot in the last 10 years, and it may continue to go up, may not. I'm not that great at predicting, but I was a little more nervous that we're closer to highs than lows in the stock market. Secondly, just from an interest rate perspective, I saw interest rates, I thought they were going to trend up, and as it turns out, I feel that more so now that they're going to be trending up. And I like assets like real estate in an inflationary environment. I think that that's going to maintain its value more so than maybe some other asset classes. So I decided to kind of tilt more toward real estate. And more specifically, even though I'm kind of by nature a conservative person, I decided that I was going to take on some debt in order to do it. Where traditionally I've purchased things more with cash, but I decided to do it more with debt just because I like being able to get money at 3% and to have something appreciate above that. So
I'm curious, with your previous investment experience in real estate, was there some pain points there that led you to that?
So I went into a small partnership with a very few other people on the south side of Chicago a number of years ago. And we were in a neighborhood that was not too far from the University of Chicago, which is a fantastic institution, but does have some rough areas around it. And we thought that certain area was going to gentrify and do better. And, so we invested some money there to build some housing, and it was a disaster. So we lost a lot of money. And two specific things I can mention is I guess I'm a little cynical about this now. We made the decision we weren't going to pay off people, okay? In terms of, housing code, all those kind of things. Well, it's hard to do business in certain areas of Chicago if you don't. And number two is we actually let a guy stay in one of the units for free if he kind of guarded the property for us. Well, that didn't work out either because they basically stripped the copper out of some of the units and blah, blah, blah. So, it was a painful experience. So that's kind of my war zone story.
And I'm sorry that you had to go through that, Bob.
Education, you get it one way or the other.
We're looking at key performance indicators here. So what we're showing here is that Bob's lifetime return on investment is 9.74%. And that lifetime return does not include home price appreciation. We'll get into more of that in just a second here. He's been investing for 0.5 years. Literally, you guys just saw that he invested, his first properties were purchased in July of 2021. His lifetime net rental income is $369. Which is great that it's positive. Of course, it's going to be relatively low because he's only been investing for, 6-7 months by the time that this reporting was done. But his lifetime total return is $6,623. Again, that does not include home price appreciation. Bob, you want to take a stab at why that lifetime total return number is so much more than the net rental income number?
Maybe principal pay down?
Yeah. Exactly. Principal pay down and tax savings. If you're not paying attention to things other than cash flow, you're missing a big component of why you're investing in this asset class, right? Roughly $6,300 of his total return is things not named cash flow.
It's a big deal.
Which is really, really cool.
Yep. Keep going.
Keep going.
All right. Just got to talk to me, buddy.
All right. So, when you were prepping me for that beep, 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 beep,
yeah,
for rent increases. All right. I did a little extra research on Bob's portfolio because I'm looking at his returns. And we're crushing it right off the bat. And typically in a client portfolio, it takes a little bit of time for you to reach your goals because you've got fees up front. You've got tenant placement fees up front, which immediately, right, you're going to have a resident in there. So it's good to have a resident in there, but that's going to make it harder for you to be right at expectations right off the bat. But you're going to see here that we're right at expectations for Bob. And so I'm like, well, how are we doing this? And so the first thing that I went to go and look at is, what did we tell Bob his expected rents were going to be on his evaluations, and what were they actually rented for? which is really, really cool. So Bob, not sure. Are you familiar that we over rented all 3 of your properties?
I like it.
I love the passive nature of Bob's approach, right? This is fantastic, right? This is the way it's supposed to be. Like pleasantly surprised is how I want all of our clients to be.
It's
right?
great.
So on Superior Street, the evaluation that like we just saw the evaluation here on No Road. Well, this one on Superior said 1125. And when the actual lease was signed for a 2 or a 3 year lease, it was 1150. Right. So additional cash flow of $300 a year right there. Right. 8102 Eaton Avenue, we said 1250. The actual rent on that one came in at $1331 a month. Really cool. Almost $1,000 of annual cash flow. And for Cheryland Avenue, original expected evaluation rent was $1275. Actual current rent right now is $1298 for almost $300 in annual cash flow. You add all 3 of those up, and that's an additional $1,548 of annual cash flow that goes straight to the bottom line for Bob. And that's why we are at the point that we're performing so quickly for Bob's portfolio. Is that pretty cool?
That's pretty cool, man.
Yeah. Another thing to keep in mind is like a $1,500 annual cash flow number is huge when we're talking about expected total monthly cash flow and expected return on investment. Because if you guys remember what we just talked about for No Road, it was $100 a month, right? That's $1,200 a year.
Yeah.
Right. Like if JWB wanted to be super aggressive on what we absolutely thought we could get for rent, I could easily put every one of these evaluations here at 10%, 12% returns, 13% returns. But this is going to our core values of under promise and over deliver, setting up Bob for success and, hopefully helping him get his goals even quicker. So pretty cool.
This next slide this is the cherry on top of the cake here for you, Bob. This is the GC extra work that he put in just for you, man. Talk to us.
Well, and I love showing the 5 profit centers. I think so much of what our message is on the show, especially on the property of the week, is to help people see beyond just cash flows, right? If all you did was look at cash flows, I don't think rental property investing is the best asset class to invest in. If all you looked at was cash flows, there are other asset classes that are better, right? But the reality is that there's 4 additional profit centers that we look at. And when you combine all 5 profit centers, this is the best risk-adjusted return, in my professional opinion here. And so I wanted to shed some light on all 5 profit centers for Bob with your portfolio. And here you can see the net rental income, like we talked about earlier, is $369 for his half a year of ownership. The big thing there is that it's positive. That's a win for us, right? It's not going to change Bob's life that was $500 or $200, right? It's just positive, and that's the key. Next, we're looking at tax savings, $2,428 in tax savings, taxes that Bob doesn't have to pay because he's investing in rental properties versus another asset class where you don't get these same tax advantages. Principal paydown is $3,826. Bob, can you talk a little bit about how much you love principal paydown? I know you mentioned it earlier. Tell folks what principal paydown is and why you love it.
Well, basically, you're having someone else pay your mortgage for you, over time. And it's fantastic. You just see your equity grows at an increasing rate, actually, because in the early years of a loan, you're paying mostly interest. And then as you get into it more and, years 5, 10, 15 down the road, if you hold it that long, they're really paying down your principal at an accelerated rate.
Exactly. Right. How cool is it, number one, that somebody's paying your loan off for you? But what Bob's talking about is this profit center gets better with time, which all of these profit centers get better with time. And so it's really wonderful. What Bob's also talking about is even if the house doesn't appreciate, you win as your resident pays your loan down for you. You gain equity that way, which is really, really cool. And a great segue into talking about home price appreciation. Bob, you bought at an incredible time, right? For those who are thinking about buying right now, this still is an incredible time. I've never been more sure that home prices are going to rise over the next year than I am right now, right? It's because, quite simply, supply is really low, demand is still high, and they can't build homes fast enough to make this an equilibrium market. So you're going to see home prices rise. It's very, very confident that's going to happen. And Bob, for you, you bought at the right time too, right? You bought at an incredible time in the middle of 2021. And so while the overall Jacksonville market has appreciated between 15 to 20% year over year, you've owned it for half the year. So that appreciation on your 3 rental properties has gained you $50,900 in equity right off the bat. How cool is that?
It's a good start.
It's a good start. It's about the best start. When I started to invest in rental properties, I did not start out with that start. So I'm super happy for you. And then the last profit center is inflation hedging. And inflation hedging is something that is a little bit more complicated to talk through, but I don't want to gloss over it. I think it's a really important teaching moment for us to understand how impactful it is to be holding hard assets and taking out debt in an inflationary environment. It's hard to calculate what the savings is here or the profit center of return is here. Inflation hedging means that your rents are going up as the cost of goods and services go up. And it's showing in that home price appreciation number because the cost of houses go up as inflation happens. But what many people don't understand is that it also becomes easier and easier for you to pay down your loan. You're kind of riding the wave of inflation. It becomes easier and easier for you to pay down your loan when you have smart debt in place and inflation is happening around you. Because what's actually happening is we are all taking home more money in inflationary times. The problem is that all of our cost of goods and services around us are going up as well. That's why people don't like inflation. But how cool would it be, Bob? How cool would it be if you could just bring home more money just because that's the wave you're riding, which is inflation, but you could hold one of your costs to be fixed for the next 30 years.
Right.
Be super,
It's a
super
better time
cool.
to be a borrower than a lender, in my humble opinion.
100%, because you as the borrower, you are paying down your loan with less valuable dollars in the future.
What's your advice to a lesser educated version of you that's looking to start to grow a portfolio, kind of like you've been able to?
First of all, make sure you have everything else in your life set. I mean, don't overextend to get into real estate, So,
Agreed.
Work within your means, have a plan for doing it, but do it. Because I think if you do hold over a cycle, you're going to make money. It'll be a prudent investment. I mean, it has in the past anyway. So, and this applies not just to real estate, but to many investments, the sooner you can do it, the better. I mean, time is on your side. If you can invest when you're 20, 25, 30 years old, you have a very long span. Those assets can appreciate. So if you can do it early, it's a great time.
It's great advice.
Agreed. Bob, just really wonderful to hear your story. Thank you so much. First and foremost,